Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The stock story of the day is Nvidia. Always highly anticipated. They reported numbers in line, guidance in line, but it wasn't a beat and raise like a lot of investors had become accustomed to. A lot of fuzziness in the numbers and the estimates out there, whether to include China revenue, not to include China revenue. Are you giving the U.S. government its 15% cut? I think the numbers are kind of squishy out there, at least in the near term. That's a CFA term, squishy. Kunjan Sobhani, it's his job to kind of make sense of it. He's a senior analyst covering semiconductors for Bloomberg Intelligence. He's based out there in San Francisco. Kunjan, love to get your informed opinion about what you saw from the good folks at Nvidia last night.
Yeah, like you said, it was once again a solid sprint and guide. It checked all the fundamental key boxes. But as has been the case with this name, the expectations always run higher. And maybe not all the numbers were able to clear that high hurdle of expectations. Specifically, the data center compute numbers in 2Q, we would have liked to seen that come in a little bit high. But there were still a lot of strong positive underlyings. One, the networking was a significant beat, which shows the strength and the attach rate that they're getting from their networking switches and chips in the Blackwell ramp. Second, like you mentioned, the 3Q consensus had China included, and they still beat their 3Q guide without China. If you add in the China guide of 2 to 5 billion, they would have handsomely beaten the 3Q numbers. So that noisy sort of consensus shadowed the goodness that is coming out of the guide of Nvidia.
All right. So what's the company telling us now about China? Because quite frankly, I'm reading the press. I don't know whether they're going to be able to sell stuff into China or when, or whether they're going to have to give a 15% cut to the U.S. government. How's that going to play out?
Yeah, so China still remains, after the earnings, sort of that overhang in terms of uncertainty. The company did guide to a 2 to 5 billion revenues from the H20 in China in next quarter, which is positive. That means they feel confident that they'll be at least be able to ship some and get some of the revenues back. But yes, the spark here for the China story will not appear until we have a clarity, and we believe until they have a Blackwell version of a China chip, which they get approval from the government. That will really open up a massive amount of revenues coming from China. And there's a lot of hurdles you need to clear, right? There's the government, which has nothing to do with Nvidia. The US-China relationship needs to get sorted out, because now even China can put in a roadblock from Nvidia selling or allowing their companies in China from buying Nvidia chips. So there is work to be done. As you mentioned, the 15% cut is not ironed out in terms of laws. We have heard news stories about potential lawsuits. So those two, government and geopolitical angle, needs to be cleared before we can start seeing billions of dollars of data center China revenue coming in.
Kunjan, what's the competitive landscape here for these chip companies vis-a-vis Nvidia and just kind of positioning for AI? I assume Nvidia's position A. Who's kind of B and C?
Yeah, so, this space is divided into two categories. One is the merchant GPUs, which is what Nvidia sells and dominates that landscape. The sort of second competitor there, or the B, is AMD, which is a very far distant, Nvidia today has about over 90% in terms of revenue share. Wow. And the remaining is going to a very small to AMD. But there's other piece, which is what we call ASICs, which is what these big hyperscalers and cloud providers like Amazon and Google design their own chips. So that's sort of the other competitive landscape where there's a risk of the ASICs taking sort of share away from merchant GPUs. Even though they don't compete directly for the same socket, they could take away the wallet share.
And so does that mean companies like Nvidia have to pour money into R&D for that next chip to stay on front? Because I know in your business, technology changes quickly.
Yeah, definitely. I mean, look, Nvidia has been even before the AI advent happened, Nvidia has been the biggest R&D spender. They have continued, and this is what really got them to this stage of being ahead of everyone else, and they have to continue outspending everyone else to sort of keep that lead. Their roadmap for the next 2.5 years does suggest that they should be able to keep this lead handsomely, and for that, it will definitely require high R&D spending.
So this name, to me, who I'm used to stocks trading at much lower multiples in my world, but this seems like a stock that can actually earn its way, and we have seen it earn its way into its multiple. I mean, you can make an argument this is not an expensive stock.
You're right. I mean, if you look at from a historical perspective, it's actually the multiple is much more lower than what we have seen Nvidia trade in the past 2 years. Wow. So given that fact, and also when we look at the relative comparison, when you think about a company growing at 50% and making revenue in the hundreds of billions, that is unprecedented, especially growing with gross margins of 70 mids or low 70%. I mean, you're talking about a financial profile of a software company, not a semiconductor company here. So definitely when you take into those two things into account, it does seem that it might not be really highly valued.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Dollar General, the stock's pretty much, they reported numbers, lifted their guidance. Stock's flat today, but boy, it's up 47% year to date. So the street definitely likes what's going on at DG. Let's talk to an expert on this, Jen Bartasha. She covers all the retail stuff for Bloomberg Intelligence. Jen, what'd you take away from Dollar General's results?
Yeah, hi, Paul. Overall, the results were pretty encouraging. And we're looking at the consumer who is willing to spend selectively, and the value proposition for people who are in that discount space is really resonating. And so the tactics that the companies put in place to really improve store operations and things like that seem to be gaining traction and drawing more people into the stores.
Drawing more people into the stores and drawing people from different income strata as well. More higher income customers are coming in. So that being the case, Jen, does it need to broaden its selection of products available to customers?
Well, I don't know that they need to broaden the selection, but they need to be thoughtful about the selection that's in the stores. I mean, these are small boxes, so you have very limited space. And in order to retain those higher income consumers from middle income, high income that are coming into Dollar General, part of it is going to be making sure that there are things that are fresh and interesting, but still at very good value. And I think one of the interesting points is that Dollar General has been able to maintain a selection of things at a $1 price point. And when you think about it, their biggest rival in the dollar space, Dollar Tree, moved to $1.25 as their baseline price. So there's definitely some opportunity there to appeal to that value seeker and give them something to be excited about.
So if I look on the back of, or on the tag for most of those items, I'm going to see made in China or something like that. How are they dealing with tariffs? How much are they passing along to consumers versus maybe taking in their margin?
I think one of the advantages Dollar General has is that they have a lot less exposure to imports than most other retailers in the discount space. And that's really because over 80% of their sales are consumables, which is more food and household items. And the discretionary parts, which would be the decorations, the apparel, that sort of stuff, is a much smaller part of their business. So they're able to mitigate some of the costs. They did talk about passing through prices when absolutely necessary. But I think that's part of the solution for Dollar General is that product mix is playing in their favor right now.
Right. So they're like a smaller scale Walmart in many respects rather than a smaller scale Five Below, for instance. So given all of that, Jen, you had mentioned Dollar Tree being one of the biggest competitors to Dollar General. That company reports September 3rd. How much can we take away from Dollar General and apply it to Dollar Tree?
Well, I think Dollar Tree is in a bit of a unique position because they've shed off the Family Dollar operations, which means that they can really now focus on getting Dollar Tree to function at the best that it possibly can. I think that you have customers who are going into Dollar Tree. They have a multi-price point program that they've been rolling out that's been doing pretty well. That should help support some of the top line growth. It's really going to be a question about margin for Dollar Tree and how much tariffs are impacting them already. Although from what we've seen from other retailers, that impact may still be delayed into further in the second half of this year, just because they already had things in inventory that they're currently selling.
So, Jen, in Anytown, USA, do these $4 stores, Dollar Tree, Dollarama, all that, are they all in the same town together, or is it more regionally carved out?
Well, Dollar General by far has the greatest penetration into what you would call rural America. And so you find them in very small communities, sometimes as one of the key retailers in very small towns. When you look at like Family Dollar, it tends to skew a little bit more urban. There is some rural presence, but not nearly as much. And they're in the process of closing a lot of stores. For the other dollar, the other dollar and low price providers like a Five Below, they're still in the growth stage. So they don't have nearly the number of stores. You have to remember Dollar General has over 20,000 store locations in just the United States. So it is pervasive through a lot of smaller communities.
That's amazing. I didn't know that.
That is pretty remarkable. Now that Dollar Tree is shedding Family Dollar, what kind of opportunities does that provide for Dollar General?
Well, it certainly gives an opportunity to look, especially where stores are closing in terms of gaining market share, but it's also about reasserting value position and capturing customers that have been dissatisfied or who may be looking for another alternative. We also saw Party City close, last year and into the beginning of this year, and so there are strategic opportunities where they can go after some of those types of occasions that historically people might not have gone to Dollar General for.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the ones I always like is Dick's Sporting Goods. Give a sense of how the sporting goods business is doing. And they reported some numbers, stock trading off a little bit here. Lindsay Dutch joins us, Consumer Hardlines Senior Analyst for Bloomberg Intelligence. Lindsay, talk to us about Dick's Sporting Goods. What did they report most recently?
Hi, Paul. Thanks for having me. Yes, Dick's Sporting Goods had another strong quarter, 5% same-store growth. That's an acceleration sequentially and year over year. They're seeing strength across apparel, footwear, team sports, and golf. So a strong quarter, but the stock is trading off. And I think a lot of that is sort of a conservative outlook for the second half, with some uncertainty. And a lot of investors are still worried about the incorporation of Foot Locker with that deal to close in September.
Talk just about the Foot Locker deal. What's the upside there?
Yeah, so the Foot Locker deal is a little bit different for Dick's in terms of, it leans a little bit more towards lifestyle rather than sport. It is a big acquisition. You're talking about adding about $8 billion in revenue. It also, Foot Locker skews to a lower income consumer, and they have mall-based stores. So it's a little bit of a different animal for Dick's. Dick's has proven their own turnaround over the past couple of years, and they really have strong demand with their assortment, but they're going to have to show that they can do that again with Foot Locker.
Is there a carefully articulated strategy about integrating Foot Locker into Dick's? Or I know they said that they're going to run it as separate business units. So I'm wondering, what's the point of buying Foot Locker then?
So you're right, correct. They're going to keep the Foot Locker banners. They're going to keep the stores. As a customer, you might not even know that Dick's has made this purchase. I think the big thing for Dick's is expanding, their customer reach and therefore the longer term opportunity for the company as a whole. So like I said, Dick's already caters to more of a sports type focused customer, a higher income consumer. Foot Locker is bringing a whole nother consumer set. to Dick's. And they're going to really try to lean into their expertise on assortment, bring newness to footwear, bring a little bit more apparel into those Foot Locker stores. And they're going to try to gain market share, with this broader reach.
Lindsay, what are the Dick's of the world, the Foot Lockers of the world, what are they saying about tariffs and how much they're going to take in the margin, how much they're going to pass along to consumers? Because I think a lot of sneakers come from China.
Yes. So Dick's noted that they have seen, some price increases. They sound more sporadic in nature. That's relatively consistent with the other, coverage in my retail universe. We're seeing very few retailers, to take every single item up by a certain amount. So the price increases are coming in more selectively. They're most easily passed through to the consumer when it's a new product, something that people are willing to pay up for anyway. So they have seen, new things coming from, say, a Nike, for example. You may be able to get that customer to just take on that price increase. In terms of margin, when I think about Dick's, they're still expecting expansion both on the gross basis and on an operating basis this year. They are trying to manage costs as well, but this company is also investing. They're opening new stores. And so that is adding, additional cost pressure, not just on the product side.
So, Lindsay, I got to ask you about Best Buy as well. The stock is down more than 6% in early trading, even though the second quarter did beat analyst estimates, and the company ended 14 straight quarters of quarterly sales declines. What has investors disappointed?
I think the real worry bead for Best Buy is demand for second half. So even this year, just for the first 8 months of the year has been a little bit of a wild ride for Best Buy. We came into the year with positive demand momentum. Things were looking good. Then we got tariff announcements. We had to roll back guidance. There was a lot more uncertainty. And now we're flipping back with these results to more on the positive side. So I think there's concern entering the second half of the year about where demand is going to shake out. We did see strength, in gaming, particularly with the Nintendo Switch 2 for the second quarter. We are seeing momentum continue in computing and phones for the third quarter. All of that is positive, but home theater and appliances have sort of remained weak for Best Buy. And that home theater entertainment category, that's a really big one for the fourth quarter.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We want to go back to company news and how the NASDAQ is the lone index there that is really moving higher right now. A lot of it can be due to earnings from companies like Snowflake, like CrowdStrike, not necessarily to Nvidia, which is lower. So let's bring in Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. And Mandeep, I wanted to start on CrowdStrike because I know what they do, but I'm going to go to Snowflake, which is up about 18.5% in trading right now. It's another one of these enterprise software companies that there are so many of. So let's talk first about what Snowflake said that got investors so excited and how tied to the AI story it is.
Yeah, Snowflake is another one of those database analytics companies that got beaten up because everyone thought LLMs will take share from them. And there's been a pretty wide spectrum when you look at the valuations for database and analytics companies. On the one hand, you've got a Palantir that's trading at almost 100 times sales, not earnings, sales. And on the other hand, you've got, players like Snowflake that are at a much more reasonable valuation. MongoDB, the stock is up almost 50% since they reported earnings 3 days back. So to answer your question, what they said was they are now participating in this AI agent deployment. Basically, all these enterprises who are renting the GPU capacities, who are trying to build a product on ChatGPT, they're actually deploying that in production now. That AI agent, customer service agent, or that search chatbot is getting deployed with enterprise data. And that is what I think is helping someone like Snowflake, which caters to enterprises, but everyone thought they would be disintermediated with a ChatGPT solving all the problems. So that's not the case. That's why MongoDB did well. That's why Snowflake did well. Not every company is going to participate like that, but clearly these companies have, and that's why you're seeing their stock getting bid up.
So these, I guess they're classified as infrastructure software.
Yeah.
And
Databases,
again, and they're databases.
Yeah.
And so databases, they're gonna have value in an AI world, right? I would just think as the raw material of data for these large language models.
You go back in the last 30 years, database is one of the stickiest business. Like think of Oracle database. Nobody was able to get rid of their Oracle database.
I think of Bloomberg's databases.
Look, I mean, and that's why databases are like so hard to displace. Once your data is in a particular product's database, you can't really migrate it. I mean, there's no way out. Technology will come. There will be AI. What do you train AI on? It's your data, right? So your custom data is still in that product. And that's why mainframes are still around. So from that standpoint, I think database, when you look at their gross retention, their net retention, their metrics are always better than application software. You can replace your application software with a ChatGPT product that can automate the whole thing.
I see.
But that's where the stickiness comes from. And, the pendulum keeps swinging. I mean, the market was very bearish on these companies for a while, but now they're realizing, oh, guess what? They will participate in this AI deployment. And I think Snowflake is definitely one of them.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.